Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Returning on the program today with us is Rick Rule for another installment of our Palisade Sprott monthly market update. Rick, welcome back to the program.
Nice to be back with you, Colin. Thank you.
Rick, sentiments remain generally weak across the junior equities, and yet many people are noting their underlying bullish outlook, particularly when looking at the charts for both gold and silver. I just want to start off and see how you feel, and if you feel we might be on the verge of a breakout at some point in 2018.
Well, our experience here has been different. The client response at Sprott in the first quarter has been very strong, I think led by a fairly strong private placement lineup. But we've seen investor interest, both high net worth retail and also institutional and Asian interest, really across the board in precious metals and natural resources. Perhaps we are anomalous in that, we focused in the space for a long time, but our own experience has been that there's a lot of investor interest in the segment from the smallest client to the largest client. I think that's driven by the fact that in 2017, while the resource equities didn't perform particularly well, the underlying commodities performed fairly well. And one consequence of that is that the better resource equities offer pretty good value relative to the commodities. And I think that's being reflected in the business that we've seen in the first quarter.
Rick, the amount of pain that the miners had to go through from 2011 to 2015 was extreme. And as you pointed out at the time, it would cause for a sector that would improve in strength and business models that would improve. Looking at those companies now, are you seeing drastically different returns in terms of going back to profit and just getting kind of orders in a fare so that they will fare better moving forward?
Colin, I think that's a very good point. I was just listening to the Agnico-Eagle quarterly call. And of course, they've always been top decile in terms of financial performance in the gold sector. But it was useful listening to them, a gold company, a public gold company run like an actual business, not talking about themselves as a leveraged call option on gold, but rather talking about operational efficiency, return on capital employed, by the way, on a per share basis, not on an enterprise-wide basis. I think that the next couple of years in the natural resources business, but particularly in the precious metals equities business, are going to be much better than people assume they're going to be. Firstly, because the assumptions are so poor. And secondly, because for the first time really in my 40-year career, gold mining companies are being operated as businesses rather than leveraged options on gold. I think your point is very astute and very timely. I think we're into the improvement period as we speak.
In the past, Rick, you've given a lot of focus on the concept of optionality plays. The prices of these metals, as you pointed out, firmed up last year, and most of them were in an upward trend, but they certainly haven't broken out to the point where many of these out-of-the-money gold deposits or other deposits have hit that level where they come back in the money. Are you still focused heavily on looking at optionality plays?
No, the optionality plays gave us everything we wanted in 2016. The large out-of-the-money deposits in 2016 were uniformly up 200%, 300%, 400%. So we have moved on to exploration and discovery plays and to names like B2 Gold, where the operational efficiencies, the cash-generating capabilities of the companies have come to the forefront. There may be a time again for optionality, but I don't think we're in the right place in the market for optionality plays, except for perhaps on deeply, deeply, deeply out of the money commodities like uranium, potash, or phosphate.
With optionality plays kind of behind us, then what are you looking for on an exploration play basis when you're investing or suggesting for clients at this point?
Four things, Colin. First of all, the prospect generators, which, as you know, I believe are statistically the most valid exploration model that there is. Companies that understand that they're in the intellectual capital rather than the physical capital business. I'm trying to complete private placement financings on every competent prospect generator on the planet this year. So that's the place I start. The second is sole risk exploration where I have the third dimension. In other words, where I have a drill hole that has validated the exploration target. Certainly the results that we enjoyed a couple of years ago with Mariana in Hot Maden and with Reservoir in Timok showed our clients the advantage of the third dimension, a good drill hole that the market doesn't pay attention to. The third area that I would look to are the very, very high quality people, either the old 7-footers of my generation or the young 6'10" but still growing teams of your generation. The serially successful people who already have a couple of successes under their belt. The fourth thing that we're looking for in exploration is companies that are well enough funded that they aren't going to have to come back to market in the very near term so that they can use money which is already in the treasury to answer unanswered questions. And that last theme I talked about, the answering unanswered questions, is the most important part of the exploration business. It's important for your listeners to understand what the value proposition in the company is. You add value by answering unanswered questions. So what is the question? What's the probability of a yes answer? How long will it take to get a yes answer? How much money will it take to get an answer? And do they have the money? Those basic fundamental questions in exploration are the questions we're going to be asking. I don't believe that the exploration sector is going to really move in 2018. I believe it's going to really move in 2019. And I want to have big, fat positions in the best of the best in anticipation of the sector moving up dramatically in 2019, which is what I think will happen.
I recall a discussion that we had several months ago surrounding warrants and how to use warrants to best profit. And one of the ways was, of course, using warrants to benefit from the upward price movement of a commodity itself. The other one that you discussed was, as you just pointed out, answering an unanswered question. Warrants are obviously something you focus on quite a bit at Sprott. What is your kind of outlook at this point on the private placement market and the deal terms that you're seeing compared to a couple of years ago?
The deal terms are improving because the generalist investor, even the generalist small hedge fund, has stayed out of the sector. And that means that the competition that we're getting from the Canadian dealer network is more constrained than it had been. What we are increasingly able to attract are private placements where the warrants trade, where they're detachable and they trade. This is important because the tendency for most speculators is to sell the stock and keep the warrant for free. The consequence of that with a tradable warrant is that the warrants often trade way in excess of their intrinsic value. So increasingly, what I did in 2017 with the tradable warrants was, rather than selling the stock and keeping the warrant, I've sold the warrant and used the profits to reduce my basis in the stock. I'm always looking for arithmetic where the market itself is making a mistake, and I can take advantage of that. But the truth is that the warrants are a very important way for accredited investors to get a double benefit from funding the answer of an unanswered question.
Rick, you mentioned two commodities a bit earlier that are still buried deep in the bear market, potash and uranium. First part of the question, are there any other commodities that fit into that category? And then with those commodities identified, let's talk about each sector and what you see potentially playing out there.
Well, certainly phosrock too, phosphates. The outlook, the near-term outlook for agricultural minerals is absolutely bleak. They're in tremendous oversupply. Soft commodity prices, soybeans and grain, are off substantially, which means that input purchases by farmers have been off. And the consequence of the very bleak near-term supply and demand outlook has led to a circumstance where the commodities are being sold for less than the cost of production, which is always something that I look to. I can't tell you when the prices for these commodities will turn. What I can tell you is that in my 40-year career in mining investing, buying essential commodities when they are selling for less than the cost of production is something that has benefited me. Either the price of these commodities returns to its cost of production, including the cost of capital, or we lose the ability to fertilize soil, which is a different way of saying we lose our ability to eat. My suspicion is that time is on my side for this trade. But as we've noted before, Colin, I'm much more patient than the average speculator. With regards to uranium, the circumstance is different. When you look out 3 years, 3.5 years, there's no challenges to that market whatsoever. The pace of new build reactors is very, very strong. The problem is in the very near term, and the very near term, which I would see as being in the 12 to 18 month time frame, I think is really a function, as we've discussed on your show before, of Japanese reactor restarts. When you begin to see restarts, I shouldn't say when, I'm sorry, if you see Japanese reactor restarts, the shutdowns that we've seen of productive capacity, the supply destruction that we've seen in Kazakhstan and Canada, will have a very dramatic impact on the market in the face of Japanese reactor restarts, if we see it.
Rick, I know that we've spoken in the past about the EV metals such as lithium, cobalt, and nickel. We haven't really spoken about more of the electrification metals on a grid scale, so things that could play into renewables like vanadium or wiring things up like copper. What's your feeling on the metals associated to that part of the market?
I think that's a great question. I like metals that are going to move anyway, but that have an impetus to move. And I would describe both copper and nickel in that consequence. Nickel in particular has moved a bit recently, but it's been produced for a very long time for less than the total cost of production. If nickel supplies falter, you run out of stuff like stainless steel. But there is this huge new impetus to nickel consumption as a consequence of its critical nature with regards to batteries. Copper, as you describe, is part of the whole electrification story. And it isn't just about electric vehicles, although that's important. The whole world aspires, Colin, to the way that you and I live, and that requires electrification. About 70% of Africa, as an example, is unelectrified, bringing the world closer to the standard that you and I live requires all kinds of copper, irrespective of electric vehicles and things like that. So, again, your question is very, very topical. I'm not as versed with vanadium as a market. It's a smaller market than either the copper or the nickel market. And it's a market that's rapidly evolving in terms of metallurgy. So I'd rather not expose my own ignorance with regards to vanadium. But I'm very attracted to the nickel market. I'm very attracted to the copper market, with the caveat that in those great big broad markets, you want to either be in the lowest cost quartile or you want to be focused on a large-scale exploration project that will be, if it's successful, in the lowest cost and best capital efficiency quartile in the market. I don't want to be in the small marginal projects in either case.
In a bit of an out-of-the-box question, and this pertains to how do you know if a commodity has overreacted to a demand that is in play or upcoming? Looking at the lithium market, that was obviously the first one to move from this whole EV space, and it went up about 8 to 10-fold in terms of the lithium concentrate prices. I think that most people would agree that it looks like more lithium is going to be used, but how does an investor know if there's any fat left in the trade, or has the commodity price outpaced the actual price that's needed to incentivize production?
I'm a reasonably poor trader, Colin. Certainly, the operating margins in lithium are so fat right now that capital is over available to the sector. My belief is also that the shortage that we've experienced is a consequence of skyrocketing demand that increased faster than productive capacity could be added. The world is awash in lithium. What the world hasn't been able to do is clear out the production log jams quickly enough. My suspicion is that in 2 years from today, that the market will be oversupplied, not undersupplied with lithium. That doesn't mean that all of the cash that's going into the lithium business won't discover and develop a top quartile project. It just means that the sector itself will certainly be oversupplied and see price weakness in the underlying commodity. The more interesting commodity to me, although it's still a very, very hot commodity, is cobalt. I think we discussed on your show before the fact that cobalt is the first commodity that I've been aware of in my life where the consumers have said they will happily pay more for the product if they could increase supply. That the potential fabrication uses for cobalt in a variety of applications are so great that the manufacturing demand for cobalt has been held back simply as a consequence of supply. I've never seen a commodity before where the users have told me that they would pay twice as much per unit if doubled or tripled unit availability. The problem with cobalt is, or at least the problem with cobalt as an investment theme, is that one gets cobalt from Congo, Russia, and Cuba, which are not countries that investors favor. Everybody seems to want politically correct cobalt. And the problem with politically correct cobalt is it's way, way in the wrong part of the capital efficiency curve and way, way in the wrong part of the cost curve. If somebody wants to play the cobalt game, and they really want to play the cobalt game, the sad news is that they almost have to go to Congo. And the sad news associated with going to Congo is they are almost certainly in the next 18 months going to participate in a civil war. I've chosen to do that, but it's not for the faint of heart.
Rick, on a macro picture, are you concerned at all about Trump's latest policies whereby he's beginning to engage in a trade war with our largest trading partner? And also, how do you think that might affect our investment sector being commodities and precious metals?
I'm hugely concerned about trade wars. Trade wars benefit no one. They make everyone poorer, with the exception of small concentrations of economic interests. I believe it was Mencken who said that elections are advanced auctions of stolen property. So I assume that Mr. Trump has identified some beneficiaries who he feels might be useful to him in the next election. But the truth is that trade wars make everyone poorer, not just in the context of our trade relationships with China, but also our trade relationships with the EU, with our northern and southern neighbors and with the rest of our Western Hemisphere trading partners. Trade wars make everyone poorer, and commodities investors want everyone to be richer. It's a very, very bad juxtaposition.
All right. Well, on that note, that sums up my line of questioning for today. And Rick, thanks as always for coming back on the program and addressing our audience.
My pleasure, Colin. It's a pleasure to be interviewed by you. Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?